We have a bit of narration before we get into the questions here. ACE Limited is a financial intermediary active in both futures and forward markets. You've been hired as an investment consultant and asked to review ACE's activities and answer the following questions. ACE serves as a futures commission merchant to assist several of its commodity trading advisor clients to clear and settle their futures margin positions with the futures exchange. ACE is reviewing the copper futures market for a CTA client considering a long copper futures position for the first time. Details of the copper futures market are as follows. Contract maturities. You have monthly, 1 month out to 15. Each contract is for 25,000 pounds of copper. The contract is cash settled. The price quotation is in dollars per pound. So if we're looking at the contract and we see 425, that's not 425 for the contract, that's 425 per pound. The contract is for 25,000 pounds. So we can see that if we multiply that by a penny, 0.01, we'll get $250. So this contract will gain and lose $250 for every penny move. Initial margin is 10,000, maintenance margin is 6,000 per contract. The ticker for this, if you're interested, is HG. What is missing from this description is the minimum increment. This thing does not move in pennies. It moves in tenths of a penny. So if we have a price of 410, the next increment price down would be 4.099, and it'll tell you what the minimum increment is, and it'll give you the dollar value of the minimum increment. If 250 is for a penny and it moves in tenths of a penny, the minimum tick is $25. They'll tell you what the minimum tick size is. So if you're long HG, which is the copper contract, you'll make and lose $25 for every tick. That's $250 for every penny, or $25,000 for every dollar that it moves. Okay, today's copper spot price is $4.25 per pound. The constant risk-free rate is 1.875%. Each contract has a $10 storage cost payable at the end of the month. Which of the following statements best characterizes the margin exposure profile of ACE's CTA client if it enters into a 1-month copper futures contract? So the first thing we need is a futures price on this one. Let me just change this capital to a little f because it's a futures contract. So there's the 425, there's the interest rate, and it is carried for 1 month. We do have a cost of $10 per contract. It's saying $10 here. It doesn't say per pound. That would be ridiculous. It's $10 per contract. But this happens at the end of the month. So we have a full month. The $10 is over here. I see no purpose in discounting it to today only to carry it to the future. It'll be $10 in the future. So notice I just add the $10 on at the end. Since it's per contract, I divide it by 25,000 pounds because this is the price per pound. We get 4.257. Remember, I said on the previous screen, they're quoted to the 0.1 of a penny. We have an initial margin of $10,000, which we learned on the previous screen. Maintenance margin of 6,000, so we can lose 4,000 on mark to market. How much would the futures contract have to change to hit 4,000? We take 4,000 divided by 250. 250 is the gain or loss per penny, and we get 16 cents on the, again, I'm being sloppy here, on the futures price. So if the futures price drops 16 cents, and here it is here, 4.097, we would have a margin call. Now we're in a position to answer these questions, and we'll notice that there is a little bit of sloppiness here. The CTA will be expected to post a $10,000 initial margin, true, and would receive a margin call if the copper futures price were to immediately fall below 410 per pound or below a price of 102.425 per contract. Well, this is the right answer. Yes, this is not quite true. The 410, not quite true, because it can fall by 0.1. It can go from 410 to 4.099, which is above 4.097. There would be no margin call. The next tick down would be 4.098, no margin call. The next tick down is 4.097. That's a $4,000 loss. We're now at $6,000 on our margin. We would now have to bring it back up to 10K. So this is the right answer if we assume that it can only go from 410 to 409, but it can't. It can move in 0.1 of an increment. So it's another example where if you knew just a little bit more than the author, you would get the question wrong. For B, this is more of a word riddle than anything else. The CTA would be expected to post $10,000 in initial margin, true, and would receive a margin call, and this is the key right here, at any time over the life of the contract if the copper futures price were to immediately fall below $3.86 per pound or below a price of $96,425. This is saying that the margin call, the level at which you get a margin call, is fixed at $3.86. That's not necessarily true. If the price started dropping and you had a margin call, and it started dropping and you had a margin call, let's say you had that margin call at $3.87 and it dropped below $3.86, there would not be a margin call because you've already met all the margin calls. And you would get a margin call well before the $3.86 if you entered into the futures price at 4.257. So this is saying at any time over the life of the contract, implying that this is a fixed price at which you would get a margin call. The 16 cents or the rate at which you would get a call is 16 cents, floating from wherever the price is, because remember, you settle up every single day. And C, the CTA will be expected to post 10,000 initial margin. Yeah, but we cannot determine the exact futures price at which a margin call will occur. Well, that's wrong because we can. 4.097. One of ACE's investor clients has entered a long 6-month forward transaction with ACE on 100 shares of XLYA, a non-dividend paying technology stock. The stock's spot price per share is €85. The risk-free rate is constant 1% for all maturities. ACE has hedged the client transaction with a long 6-month XLYA futures contract at a price of €85.42 and posted an initial margin of €1,000. 3 months after the forward and futures contracts are initiated, XYLA announces a strategic partnership with a major global technology firm, and its spot share price jumps €15 on the day's trading to close at 123. Which of the following statements best characterizes the impact of the day's trading on the mark-to-market value of the forward versus the futures contract? Now, you have ACE over here, who has a client who has a forward contract. ACE hedged that out with a futures contract. So let's keep in mind who has what, right? ACE's client realizes a mark-to-market gain of approximately €1,500. No, the forward would do that. The client has, the futures would do that. The forward would not do that. ACE's client has a forward contract. ACE has a futures contract. We can get rid of this. The client has a forward. ACE's client benefits from a mark-to-market unrealized gain on its forward contract with ACE. That is true. And ACE has a corresponding mark-to-market gain of approximately €1,500 deposited in its margin account by the exchange. That's right. The forward contract has an unrealized gain. It doesn't tell you how much it is. It just says unrealized gain, which is true. It's an unrealized gain at that point. Whereas ACE has the futures contract, $15. €1,500 would be deposited in. Each contract, we're told, is for 100 shares. C, because ACE has entered a hedge of its client's long forward position on XLYA by executing a futures contract with otherwise identical terms, the two contract mark-to-market values exactly offset one another and no cash is exchanged on either transaction. No, the futures contract has its own central clearing, and it does not consider the forward contract. The mark-to-market is between the futures contract and the central clearing. Nothing outside of that relationship. So ACE may have an accounting transaction that says, I have a loss on my client's position, but I have a gain on my future position because I've hedged it out. They're not going to be identical because, well, actually, it says a constant 1% for all maturities. So over the life of the contract, they will be indifferent, but the cash flow pattern will not be the same. They do not offset each other. This is a no. Sorry, they do not offset each other such that no cash is exchanged. Cash is still exchanged here. This is a non-cash entry in their books saying, hey, it doesn't matter. Whatever we get here, we lost here. but it's not offset. Identify which of the following corresponds to which description. Long interest rate futures, we have a pay fixed, receive floating FRA, and a receive fixed, pay floating FRA. Let's read A. Results in a gain when MRR settles above the initial forward commitment rate at maturity. Well, for this to settle above and for it to be a gain, we must be receiving that floating rate. So we must be paying a constant fixed rate and receiving the higher rate, pay fixed, receive floating. Results in a loss when the MRR settles above the initial forward commitment rate at maturity. Well, if it's a loss if it settles above, we must be paying the floating rate, because now we're paying a higher floating rate than the fixed rate we were receiving. There it is there, receive fixed, pay floating. And has a forward commitment price that will increase as the short-term interest rates fall. 100 minus the MRR, and let's just make MRR 4%. We'll get 96. And let's drop the interest rate to 3. What will happen to the price of the forward? It'll go to 97. Has a forward commitment price that will increase as the short-term interest rate falls. Falls from 4 to 3, price went from 96 to 97. That is a long interest rate futures position. ACE's investor clients usually use OTC forward transactions that ACE must clear with a central counterparty. Okay, so since they're cleared with a central counterparty, these contracts are going to have margin and a mark-to-market feature to it. Which of the following statements related to the impact on ACE from clearing these positions is most accurate? If ACE's counterparties enter long forward contracts whose prices are positively correlated with interest rates, ACE will have to post more collateral to central counterparties than for otherwise similar futures contracts, since rising prices will lead to counterparty mark-to-market gains reinvested at higher rates. This, if you're getting mark-to-market gains that you're reinvesting at higher rates, that has nothing to do with the level of margin that you have to post. Nothing at all. So this is wrong. It would not affect the level of margin. So if the OTC contract says you got to post $4,000 of margin and there is a gain, they'll have a mark-to-market gain, but they wouldn't say, oh, you need to post more margin because you're investing that at higher rates. It would be unrelated to the interest rate. If ACE's counterparties enter short forward contracts whose prices are negatively correlated with interest rates, ACE will have to post less collateral. Again, we have another thing here, less collateral to central counterparties than for otherwise similar futures contracts, since falling prices will lead to counterparty mark-to-market gains reinvested at higher rates. The change in interest rates change your perception of whether you want futures or forwards, but does not change the margin requirement. And if you have to post a margin and there's mark-to-market for both futures and forwards, it does not matter about interest rates anymore. You would be indifferent anyways. Since ACE is required to post collateral, cash or highly liquid securities, and typically collateral, just to make a point here, would be made in highly liquid securities because it has an interest rate component to it. You'd never just leave it in cash. Since ACE is required to post collateral to the central counterparty to clear its client forward transactions, ACE will face similar margining requirements to those of standardized exchange-traded futures markets. Similar margining requirements in the sense that you need a margin, an initial margin, and you have a maintenance margin. It may not be the same margin percentage of the face value of the contract, but similar margin requirements. That is a true statement.